Can stocks pull off a third consecutive year of big gains? That's what the Wall Street Journal asked, and I find it very interesting here. Check this out. It's very interesting. The S&P 500 has surged 28% in 2024 so far. And last year, it was up 24% right there, 24% in 2023. Interesting, is it not? So the question is, check this out. Strategists at JP Morgan, Morgan Stanley, and Goldman Sachs project the S&P will get about 6.7% in 2025, which is pretty good. Bank of America and Deutsche Bank expect the index to hit 66, 66, and 7,000 respectively. What was interesting on that, though, check this out. Goldman Sachs expects the S&P 500 to gain a meager 3% a year over the next decade, while Bank of America sees flat to 1% annual growth. And their big worry is about AI. One concern darkening the 10-year outlook is uncertainty about whether AI boom will continue. Some strategists warn AI is unlikely to be as transformative as a market rally suggests. But what's interesting is that it's not just the Magnificent Seven that are running the market. More stocks are joining the rally. Traders are bidding up economically sensitive stocks that lag behind the wider market during the first half of the year. Small cap Russell 2000 is within striking distance of its first record close in 3 years. More than 220 stocks in the benchmark have closed at 52-week highs since the end of October. It would now take erasing the gains of the top 171 stocks in the S&P 500 to negate the index total return for the year. So we're seeing a broad market rally starting to pour out there, dude. See that bucket right there? That's where I keep my my smoker things in there. Jeez Louise. But I got it. I don't want to go outside and be freezing out. Anyway, point being is my Traeger my pellets. That's what I meant. It's my wood pellets. I hope that bucket keeps it empty. It keeps it dry. I'm going to have to go out there and get it. It'd freeze and I melt like a witch. All right, so I want to show you guys something here. I can't, look at how good the market has been. Here's the S&P 500. 2018, we're down 4.4. 2019, 31, 18, 28, 27, down 20, up 24. Look at that. Look at what we've had since 2000. It's insane how much money we've had since 2008. 27, 32, 22, 31, 18, 27, 24, plus again another 26, 27 this year. How many times have we actually, look at that, 31, 18, 20, look at that, 2019, 20, 21. Look at that, 31, 30, 18, 27. The year before that, 22. The 2 years previous, it's crazy how much money we've made in the market. But even here, there's the 90s, 38, 23, 33, 28, 21. All right, are we ever going to get that again? I don't know. I don't think so. But look, even here, 1988, 16, 32, 31, sandwiched by the great, the war there, the stupid Iraq war, first Iraq war. Look at these numbers, 82. Look at those, dude. Then we go back even to 75, 76. But that was preceded by these years. And subsequently, we had a 7% decline. We just have, the stock market has had massive 43, 12, 28 runs up. That's the thing is you can't miss it. That's the issue. You just can't. Just look at these numbers, man. 42, 21, 23, 20, 40. 1, 2, 3, 4, 20 plus. 1, 2, 3 right here, 50, 51, 52, basically 20 plus. 56, 28, and 54, 55. 43, 12, and 58, 59. 23, 60. It's all sandwiched by a couple of losses, but the losses are so minuscule. Here's 75, 76. We got 3 years going back to 1926. We got 3 years of 20 plus. 37, 47, nope. 58, 54, nope. Let's see, 21, 23. Yeah, right there. 42, 43, 44, 40, 45. Right there. 50, not 3 years of 20 plus, but 18.4. No one's going to shy away from that. 54. Just look at these, man. It's just insane how much money you've made in the markets, dude. And I don't know. I just, when I see that broad market rally, that makes me happy. It's not just the Magnificent Seven anymore. So, but Warren Buffett, some guy said, should you sell? What, based on what? Oh, based on like cyclically adjusted PE ratio. I can't find this article that the Wall Street Journal had in here about CAPE. But all these people say, oh, I got the CAPE ratios as record high. Let me see if I can't find that. I'll find that, but I'm just going to go back to this. So CAPE is a cyclically adjusted price to earnings ratio. And so instead of just doing PE ratio on any given day, frankly, any given year, what Robert Shiller did is he said, we're going to stretch this out so not one moment in time can really affect the CAPE. And a perfect example of that was in March of 2020. Yeah, March of 2020, in the beginning of the pandemic. We had PEs that were at rock bottom. Why? Because the prices of stocks fell off a roof, and yet the earnings were still reflected from a quarter previously. So the earnings hadn't fallen yet because we hadn't had new earnings reflect in the first quarter of 2020. We had earnings from 2019, the Q4 2019. So the earnings were here flat, the prices went down. So we had massive declines of PE ratios, and it turned out to be a good call. If you would have bought stocks, then obviously, but it wasn't because the PE ratios were so low. It's just, so anyway, cyclically adjusted, said we're going to stretch these out to more, almost like I don't want to say amortization, that's not what I'm looking for. Just make it seem that one moment in time won't affect the PE ratios. And what Shiller came up with, he said, I'm going to see if I can't find this. When Shiller went, I'm not going to find it in my, it's just, I'm not going to spend all day researching it. But anyway, so what happened was he said in 1929, the CAPE was this. In 2000, the CAPE was that, and both proceeded to had massive declines after that. And we've been at CAPE highs, market highs, since essentially 2011. There's a good book on this that talks about probable outcomes, CAPE, and this guy was very pessimistic in 2011, saying the prices are way high. He was just wrong. And look, a lot of us are wrong. They said in 2011 there's going to be mass inflation because of government spending. The price to earnings ratios are too high relative to CAPE. Everyone's just wrong. So we've had a huge CAPE run up for the last 15 years, since the highest has been since 2000. We've been saying this for years and years and years, the financial prognosticators. CAPE ratios are too high. CAPE ratios are too high. Look, they're showing the exact height they were in 1929. They never hit the 2000 because 2000 was so insane. And then you're like, okay, so why would the markets crash? And people are like, because the CAPE ratios are so high. You're like, but what caused the CAPE ratios to be so high? Well, one of the causes was low bond yields. Bond yields in the freaking dirt, dude. 50 basis points or something like that. So it's easy to say the CAPE ratios are high, but you got to look at the alternative, which is the bonds. You're going to put your money in a 50 basis points long-term bond? No. Now bonds are a little bit high. 4% of the 10-year Treasury. Can't really use that argument so much, but then you got to look at earnings. And we just look at the earnings of the S&P 500. There's still the S&P 500 PE ratio. Let's take a look at Vanguard here. Here's a Vanguard S&P 500, and we're going to see the price to earnings ratio here. Let's go down. We'll go down. Hold on just a second. You got price to earnings ratio of 27, which is significantly higher than historical norms for the S&P 500. The S&P 500 historically has been about 15.5. We'll just say 16 for simplicity. Divided by 27. So it's what, 60% higher than historical norms. But it's not in the freaking nosebleed section by any stretch of the imagination. Look at these earnings growth rate at 18.8. Will that continue? Look at the return on equity. Will that continue? I have no clue. But you can't sit there and tell me that the S&P 500 is inherently overpriced because the PE ratio is 27. It could be, but it's not significantly overpriced. Like, oh my goodness, we're nosebleeder. So here's a value index, which is more on the conservative side, not more dividend heavy. The stocks that are less priced as high because that's why they're called value stocks. They haven't had the same run up. So let's take a look. Their PE ratio is 20. Again, that's still higher than it was about a year and a half ago. So it's something that's going to give at some point. The question is, how much will it give? A 4.4% decline a la 2018 or 18, or a massive decline a la, even 2022 wasn't a massive decline. 2022, we were down, 22% or something like that? 19.4, not even a real bear market. We haven't had a real bear market of any significance since 2008. That's a little bit concerning, I'm not going to lie to you. But even the VTV is price earnings ratio is at 20. It's still got earnings growth rate 11.3. This isn't, I don't know, let's look at, I think it's VUG, isn't that the growth ETF? Yeah, let's look at the growth ETF and see what this, I imagine it's probably 35 or something like that. And again, that's high. I'm not trying to tell you it's not high. Yeah, PE ratio on the growth ETF is 38. That's high. There's no other way around that. And remember, the S&P 500, historically about 40 to 45% is in value and 50 to 55 to 60% is in growth. So your S&P 500 is going to have both those, VUG and VTV. VTV. But it's heavily weighed towards growth because the growth has more momentum, which means you get more upside, but you also get more downside risk and volatility. Anyway, I don't know. I just know as long as the earnings are there, we're good. If the earnings aren't there, we're bad. If the earnings are going to be there when it comes to tariffs and mass deportations, which will never happen, man, I don't know. But I'm sitting there thinking, this is why you have 4 years cash or some significant amount of money in your on the short term side if you're about to retire, because you just don't know, man. I wouldn't worry about it. I'm gonna sit there like, oh my goodness, what should I do? I just say, hey, go along for the ride, baby. Make sure your debts are paid off. Make sure you have some cash on the side. If you're still working, just keep plugging your money in, dude. Keep plugging. But you want to make sure your debts are paid off. Don't accumulate more debt. Pay down your debt as best as you can. Accumulate some liquidity, and just let the course run itself. All right. Love your thoughts. God bless. We'll see you. Don't forget to paw.